afternoon, everyone. Today is Wednesday, November 29. After quite a long hiatus, we're back. And back, Jack, do it again. We've got Larry Jeddeloh, a dear friend and a friend to this room. Been on numerous times, one of the keenest observers of the global scene that I know. And I'm sure we're all keenly interested to hear what Larry has to say. Before we get into it, I'm not going to waste too much time here, as is our custom. I'm going to go do our 3 dates in history. I love doing this because at least even if you guys are bored from this, I learned something. Stuff we all learned in grade school, but we forgot. All right, so in 1520, Portuguese explorer Ferdinand Magellan entered the Pacific Ocean with 3 ships. He became the first European explorer to reach the Pacific from the Atlantic. So that was in 1520. And there's 3 of them here. The second one, I picked these out at random. 1877, Thomas Edison demonstrated the hand-cranked phonograph, a record player, for the first time. Wow, 1877. Then finally, talk about coincidences. Tell me this isn't timely. On this day in 1947, November 29, 1947, the UN voted for a resolution for the partition of Palestine, splitting Palestine in half into an Arab and Jewish state. Small world. At any rate, enough of that. So it's a late hour where Larry is. Larry, for those of you that haven't heard him before, he's founder and proprietor of the Institutional Strategist TIS Group, based out of Minnesota. He's been in the business for over 40 years, held a variety of positions. I think once upon a time before I met him, he's actually a gnome in Zurich for UBS, if I got that right, Larry. And he ran money out of Switzerland. He worked for Luthol Group and a bunch of other positions before founding TIS Group in 1995. I've been a client for over 20 years, and I always learn something listening to Larry. What I like about Larry is he's got a very differentiated point of view, with a particular focus on the global scene. He's a very good thinker, strategist, and we're not going to have, there's a million different spaces you can go to on Twitter if you want to talk about the slope of the yield curve and whether we're having a recession, all that kind of good stuff. But Larry likes to think outside the box. So without further ado, Larry, I welcome you. And I want to just kick it off and have a go at it, and we'll get into some good Q&A. So Larry, welcome. Good to hear from you.
Yeah, good to be back, George. Can you hear me okay if I speak at this
We're good.
level?
We're good.
All right, good. Well, I thought I would just start with 5 or 6 topics, and then we can go from there and just see where people's interests lie. And the topics really are general macro topics, so equities, yields, dollar, gold, and then the Mideast situation. And if anybody's interested, I'd spend a minute on what's going on in Argentina, because I think it's actually going to turn out to be quite important and is completely unpriced here. But let's just start with equities, especially in the U.S., where we had November 1, 2 buy signals in the way that we work on U.S. equities, but there's a broader context for this. The 2 models we use, one is internal of my making, and it's no good long term, but it's very good short term. And it went positive on the night of October 30. The main factor that drove it was CTA positioning, which we put in our daily message that day, and it was obvious that the market was very short of S&P futures. What I didn't know was how short they were, and I didn't really find out until about 2 weeks ago when I was in Australia, where UBS was having their annual Asia conference. They had asked me to come and speak, which I did on a panel. Actually, I spoke 3 times. And one of the other panelists was a woman, very good, very, very good analyst named Rebecca Chiong from New York. And she had the number. She put her graph up of CTA positioning, and basically she said at the point uh, where the market was at on October 30, there was about $132 billion that needed to be covered by year end, which is, I think, several months worth of buying in the mutual fund area. So that explained a lot for me in terms of the very near term. But the second model is the really interesting one because that's a different model. It's not of my construction. I buy it and we've tweaked it. And I've worked with it for over 25 years. And basically, if you can envision a bell curve in your mind, and what I'm looking for is price in different time frames, I can ask the model, I can ask the program, tell me what the price of the S&P, where it's positioned in its life cycle over the next 1 to 3 months, or 3 to 6 months, or greater than 6 months. I can ask a commodity. I can ask it for rates. I can ask it for inflation. I can anything with a price. I can ask, and I get an answer. And what I've learned over the years in working with it is when you get a 1 and 3 month view and a 3 to 6 month view of the model turning from the right hand side of the bell curve, which is the bear side, at the bottom, and it starts to flip to the left hand side, which is the bull side of the curve. And the stronger the signal is, in this case, I was looking at the S&P 500, and by strength of signal, I mean on that night, about 80% of the S&P's market cap flipped on the 1 to 3 month portion of the model from bearish to bullish. That was really unusual to have that much of the market. In fact, the only sector that didn't flip was energy. But then something else happened. When we widened the search, we found that virtually all the major markets had flipped that night. Almost all the European markets. China flipped, Japan flipped, a number of EM countries flipped. So we had just a massive amount of the world equity market cap that looked to us like it was ready to go after several months of correction. We had our own model that was signaling that the market was in the clear for 1 to 3 months. And then we changed the time frame and moved it out to 3 to 6 months. And we got the same answer. So what we did was we changed our allocations. We have the highest weighting in U.S. equities we've had for quite a while. Still don't have any bonds, but I'll get to bonds in a second. We've been holders of gold, holders of miners, holders of energy stocks, which aren't working now. They're not going to work, I don't think, for another month or two. But the point was we got long. We also got long, very long, in a sector that we got a lot of pushback on, and that was we got a second buy signal on the New York Stock Exchange FANG index. So this is Microsoft, Apple, Google, and so forth. About 10 days later. And the way I've interpreted these models in the past is we're getting a run now that was started by a short squeeze, but then it's going to accelerate into year end, I think, and again, this is just a result of the client meetings we're doing. I think there are an awful lot of firms here that are benchmarked, for instance, in the mutual fund area, who, for a variety of reasons, regulatory, fiduciary rules, lack of conviction, I mean, you name it, they've found all kinds of reasons not to have 29, 28% of their S&P weighted benchmark. They can't buy it. They won't buy it. They won't buy that much. And I've seen this in foreign markets as well. When I worked in Switzerland here, we had the same problem with the SMI. You just can't buy enough stock when you have a half a dozen names that basically dominate the index. So they lag. Well, what's going to happen now is through year end is I think a lot of the long only benchmarked investors are going to have to play catch up. They may not buy the whole weight that they need in the FANG stocks and in tech, but tech in the models is leading. There is a correction that's, I call it more of a pause, actually, than a correction that's already started to unfold about 2 days ago. It's probably the last chance to do anything here. And where I think we're headed, for those of you who were around in 1999 and 2000, is it's not exactly the same setup, but it's similar, where I think we could be heading for a real blow off. And on the longer term model, the kind of 6 month plus model, this might be it for tech. That might be the top, but getting there could be extremely painful for benchmark investors who are not long enough of it, or, heaven forbid, that you're short. So, I mean, I can go into more detail on some of this stuff in the second piece, but that's the message on equities is there's one more shot here, I think. The market, interesting next year on the models, is suggesting we do go up into Q1. There'll be a brief correction probably in Q2 early, roughly April, and then the market continues to work higher. So I think if that's the way life works out, we're going to find an awful lot of managers, both in the hedge, long, short, all kinds of different strategies here. We're going to have a really difficult time with this. And there are other factors that play into this that I think might be new to people who weren't around during the inflationary years when I started in the late 70s, early 80s. This era of free money is over. And it's actually funny, George, I was talking to a friend of mine the other day, and I said, when I started in 78, 79, 80, this all looks very familiar from where I started my career, and now I'm coming toward the end of it. It looks like it's a replay of where I started. And bonds were not the asset class to own, and I still don't think they are. But let me talk about bonds here just for a second. One of the things, if you just look at a chart, just forget everything else for a moment, and look at the 10-year yield, I think it's around 430 today. So if I do this sometimes, I'll just block out the name on the top of the chart. Just look at the chart and say, well, where's it going? Well, it looks to me like it's going to about 340. So if that's right, if we have another 50 to 100 bips lower to go, that would explain the equity market performance. It would also explain why tech would lead. Longest duration assets would be the biggest beneficiaries. But that also offers up one opportunity, I think, for the Fed and the U.S. government that they may not have again for a while. And that opportunity is, it is my belief that in some regards, the U.S. is reminiscent now of an emerging country and its finances. And what emerging countries do when they have to start attracting a lot of foreign capital because they can't fund their budgets, they can't fund their deficits, is they have to keep rates artificially high, and they do it on the short end of the curve if they can, which I think the U.S. now pretty much has to do. So we'll have, I don't think, much of a decline here in, let's call it, less than 5 years on the curve. They're going to have to keep it up around 4.5%, I think, to 5%. And they'll let the area of the curve beyond that, and I'm being imprecise here, but let's call it 5 to 10 years, because they can't really raise much money there. We've all seen the busted auctions out at 30-year paper. Essentially, what we're going to adopt, I think, in this U.S. will be something we did from 1948 to 1955 after World War II, when, strangely, the debt to GDP ratio at that time, coming out of the war, was 120%. You look at it today, it's 120%. So in order to attract the capital, I think that we need to fund that debt, particularly the $1 trillion, it looks like about $1 trillion in interest expense next year. I think that what they're going to have to do is adopt a form of YCC. They're going to have to pin the rates on the part of the curve where they're going to raise the most money. And that would be the short end of the curve. So the long end becomes sort of like a tail where it'll flop up and flop down. But I think it was also a setup. I mean, history might actually be a very helpful thing to look at here. Is what happened is when they pinned the rate in 1948, they pinned it on the short end at 38 bips. It was too low. And actually, they pinned the 30-year at 200 bips, and that was too low. So the whole curve was too low. So anytime inflation was running over 2%, it was a gold mine for commodity investors and for equity investors. Those asset classes did very well. So it really, if they're going to do this, they're going to have to do it at a lower rate than where we were 30 days ago. And I think that's the key here is if in fact we get another 50 to 100 bips lower across the curve, that would be the time for the Fed and the Treasury to do this. And if they don't do it, in my view, inflation is coming back. There is a second wave coming, and they may have missed the opportunity of a lifetime. Now, as far as the dollar is concerned, if I'm right about rates, I'll be right about the dollar weakening further. And if the dollar weakens further, stocks go up. Now, what will it weaken against? The last couple, so it has to go down against something, which is always the conversation we have with clients is what is it going to go down against? I mean, I have real problems here in Europe. They're already in recession here in many countries I've been in, seeing how the euro can rise much further. Sterling, I'll see the next couple of weeks, but I think if the dollar is going to go down against something, it's probably against uh, the Chinese renminbi, which that's already reversed now. About a week ago, they started to change some things in China, and the market began to act quite differently. And the other one may be a surprise, and that is against the Japanese yen. Now, all that really has to happen there, I think, is uh, if in fact U.S. rates start to fall for domestic reasons, and the Japanese continue to allow a bleed in their interest rate market, I don't think they'll just stop buying bonds suddenly. I don't think that's in their interest. But the bleed is that just the rates go just a little bit higher. That might be enough. So you get a stronger yen and a stronger RMB, and that's enough to push the dollar not lower by a lot, but certainly enough to allow equities to continue to rally. It is extremely positive for gold, which is really one of the things I wanted to focus on for a second. Is we have spent a lot of time looking at, we own gold, we own all forms practically that you can think of. We own bullion, we've owned the ETFs, we've owned miners, so that I'm clear about where I stand with it. I bought part of an Australian gold mining company personally, so I'm putting my money where my mouth is. And on the charts, the gold price, and we wrote this about a month ago now, if we get a close over 2075 tomorrow, a monthly close, then the gold target becomes 3,500 to 4,000. If we get a close over 2,100, there's a much longer term, well, it's a higher price target. I'm not sure about the timing, how long this will take, but the target becomes 12,000. It's a six bagger. So these are really important prices in terms of where gold is going to trade here in the next, it doesn't have to be tomorrow at the end of the month, it could be December, but it just looks to us like everything is falling into place here for gold to have an enormous run. And I mean, I can give you just a good example here of we're going to talk about the Middle East in a minute. That will certainly contribute the instability that I see building in the Middle East. But there's something else that's much more fundamental, and I think I'm assuming most folks on the call here tonight are Americans, and we've witnessed what's happened to oil prices in the U.S. over the last few years when capex fell. It wasn't sufficient to supply us with enough oil in certain time periods, and that helped prices firm. I was in Australia a month ago, and it's interesting, just a brief story. Australia is a country of 27 million people, and it has the fourth largest pension fund system in the world. How do you do that with 27 million people? Well, they do it by making a 7% mandatory contribution. Employees make a mandatory contribution, and the companies then match it with another 7. So basically, their pension system, their national pension system, grows in assets by about 14% a year without any appreciation. And there are companies there that specialize in the management of those funds, and they're called superannuation funds. They have a massive problem in that their equity market also has a limited number of companies large enough to absorb all the liquidity. So it's not a dissimilar problem to having a half a dozen names or maybe 10 names at the most in the index, which you have to buy an enormous percentage of your portfolio of just to maintain the benchmark, and many of them did not do so in recent years. So since the funds now are of such a national interest, the regulator went into the market and decided that if you underperform as one of those superannuation funds by an amount that they've prescribed, essentially what they can do is they can stop you from taking new contributions in. It's essentially a death sentence for these companies because all they can do then is manage what they have and then redeem. They can be redeemed, but that's it. They can't bring in new money. So what did they do? Not surprisingly, many of them have now become closet indexers. So they've bought up all the major companies to the maximum amount they can, and the money keeps coming in. And because that's where liquidity is, that's where the new capital goes. And in the process, what has happened is when I went through the client base there one by one, almost every meeting they were telling me that small caps now in Australia are at multi-decade lows. And depending on who I was talking to, it was either a 10-year low, a 30-year low, a 40-year low, a forever low. And there are a lot of very cheap stocks there. And the reason is that the largest investors in their own country will not buy those stocks. And the comment was made to me multiple times that there simply is no money right now for small company or even mid-sized company resource investment in Australia, of all places. That is probably the most extract other than Saudi Arabia or some of the Gulf countries. It's the most extractive economy on the face of the planet, and they can't get their own small companies funded. So what I think is going to happen, besides a number of other factors that should help gold here enter a major bull market, is it takes time. I mean, I'm learning this now as an investor in a mining company. They're short people. They're short a bit of equipment. They're very short capital. And starting a mine takes time. It takes, depending on the where you're doing it and how you're doing it, it can be up to 2 years, and it's costly. So it's too much to say we're going to run out of gold, but we're not going to have enough gold if we enter a real bull market here. And so the targets I've got on gold, we are very, very comfortable with. Now, maybe just the last word here on the Middle East and the situation there, because it plays into the gold market. And I think there's a couple charts that or maps, and actually they're maps that George has put up for me, and just talk a bit about the situation there, because this is very bullish for oil as well. We're particularly bullish on energy equities. There's one, I guess the map that's up there is, that's the map of it's a representation of some of the forces, some of the resources that the U.S. has put out into the Middle East in just the last 3 months. And it's absolutely massive. The U.S. does not move this many people. It does not move this many ships, planes, subs, resources, and then not use it. What we think is evolving here. I'm going to go backwards, and then we'll stop for a second. I'm going to go back to the Obama administration and why they're in the situation they are now in the Middle East. In the Obama administration, they made a policy decision that Iran, that there was a nuclear problem in the Middle East. There was one country that had nuclear missiles. They've never admitted it. That would be Israel, but it's pretty well known and assumed that they do have numerous nuclear tipped missiles, and that the Iranians were building as fast as they could the capability of building their own nuclear weapons and launching them. And the decision they made policy-wise was that it would be a good idea if we could have sort of the same policy we had during the Cold War here in Europe, where the United States had a massive nuclear weapons resource, that the Soviets had a massive nuclear weapons resource, and by pointing enough missiles at each other, neither side would shoot. Now, that worked, and I've talked this through with a number of people here in Switzerland about why they think it worked, and I believe they've got it right. Is it worked because the Russians were actually very pragmatic. There were a lot of Russians here over the years, a lot of Russians in the banks here, and I think in this case they've misjudged. They're trying to apply that same model. They've misjudged the way the Iranians think about this. I always, when I was coaching basketball in high school, I always told my guys, believe what you see. I also, I think believing what you hear from people at the top of these governments, as outrageous as it might sound sometimes, we need to pay attention. And the Iranians have been saying for years they're going to blow Israel off the map. So I think the mistake that was made policy-wise in that administration was to start, it was the Iran deal. So now we have the new administration, and many of the same people who were active, Blinken, Sullivan, Biden, were active in the Obama years, are trying to I believe, realign the Middle East so that there is a balance of nuclear power. They're also running into something else. which was our information is that the Israelis and the Saudis were ready to sign a peace deal by the end of December, and the Iranians simply could not have that. That's why the war started. So now the boogeyman is really out of the box here, and the U.S. I think is in part moved the resources that we see on that map there, partly to keep the peace, but we also have a secondary view about this, and that is once the Gaza war is over, and I think it will be prosecuted to the end, these countries, Saudis, the Egyptians, Jordanians, they are not opposed to having Hamas gone. But the fight will really be in the north when it turns on Hezbollah, because they're much more powerful than Hamas was. They are Iranian backed. They take their orders from the Iranians, and that's where the fight's really going to turn. And we don't hear much about it in the States, but there have already been bombings in the Damascus and the Aleppo airports. This is preparation on the way. And I think now the oil, to just translate this into markets for a moment, the oil geopolitical premium that existed in the Middle East for years is no longer there. I think the price where it is now, I think Brent's about 82, 83. I mean, just on fundamentals, the EIA says we need $120 oil just to clear the market. And I've been arguing for years here, I've been arguing too long actually, that there would be one more realignment in this area. And it would result with the price of oil spiking to levels nobody expects. And if you just look through the energy companies, we had Pioneer, which Exxon just bought, but there's a lot of energy companies here that we're looking at that you can buy for, PE multiples far less than 10 with dividend yields north of 5. Big companies like Shell, good companies like Exxon, and they're not ESG friendly, not yet. But that's a whole other topic. So when the timing of this is, it's not now, it's not today. It's going to take the U.S., I think, at least 6 months to move everything that is needed out there for things to kick off. I mean, for instance, we've heard that there's like 17 days of jet fuel for the air. That's just not enough. You can't fight a 17-day war in the air. So it will take time, but I think next year, somewhere after Q2, and I know this runs counter to what I said about equities, but I think it's coming. And I wouldn't put any longer of a time frame on that than 25. I think 25 is actually going to be the year when we do have the recession and we do have the war breakout. And we have a whole different conversation to have then about markets. So, George, I'm going to stop there and let's have at it.
That's terrific, Larry. Anyone have questions, please raise your hand. So I'll throw a couple at you. Let's go back to let's start. Let's pick up where you left off with the Mideast and oil and the dollar and the UAE. I think today said something about they wouldn't take dollars anymore for
Yes.
settlement in oil, whatever.
Yep.
So could we go in a little bit to the extent you can talk about I mean, there are a lot of people out there a lot of other countries out there who wouldn't shed a tear if the dollar lost its hegemonic status. And given this sort of unsustainable fiscal situation that we're on, the path that we're on, and we're borrowing money from everybody else. I mean, it seems like the pressures are coming to bear. So maybe just opine a little bit more on the outlook for the dollar, particularly in the context of the sort of geopolitical situation. I mean, the Chinese, the Saudis, the Russians, a lot of people who, again, wouldn't shed a tear if the dollar were to go weaker. But again, we got a problem here because we have to fund our deficit. So, what does that all add up to for you?
Well, the U.S. has two great assets. We have a lot of assets, but there's two that are really difficult to replace. One of them is our military, which, in terms of size and capability, probably still eclipse everyone else on the planet. And we can enforce our will if we want to, our political will. The other one is the dollar. And I've said before publicly, so happy to say it again, I think the U.S. would do just about anything to maintain the dollar's reserve currency status because it allows us to print any amount of money to get out of a depression, a recession, fight a war, do them all at the same time. It gives us a flexibility that nobody else really has on the planet. They're not going to give that up easily. Now, on that other map that you had up there, my evil yellow map that's been on the deck for years, George. I mean, I put that there on purpose. There's a line that says Iraq priced oil in euros and Saddam fell. That's exactly what happened. He threatened to put Iraqi sales, excuse me, into euros, and we invaded them shortly after. Now, in Libya, Gaddafi tried to do the same thing. He tried to go off the oil standard as well, and the dollar standard, and look what happened to him. The UAE is fascinating because they are widely perceived as an ally to the U.S. They did, in fact, say today they're going to start accepting other currency. They've been doing this for a while. So I'm not sure exactly why they've announced this so publicly, other than to make the statement that they're open for business. And I know they're getting a lot of pressure from India. I think they may have done some deals actually with India where they paid in rupees, and from China to open those markets up and allow transactions to be done, for oil away from the dollar. That's something I just don't think the U.S. will countenance.
So I'm interested in this, going further in this topic, not just for the sake of whether once you buy or sell the dollar, but the same about capital flows. And let's put these together. Talk about Japan before,
Yep.
and talk about U.S. exceptionalism. Well, the Magnificent Seven, whatever. I mean, it's coincided with tremendous deficit spending here. Sucked in. Yeah, it's true. We've got some unique technology companies, but there's been a macroeconomic backdrop to this whole thing. So, and again, you may want to talk in different time frames. There's a very short run and there's a longer term. Do you think, and I'm asking this, it's more important for just capital flows and, whether people can put money into emerging markets and whether the U.S. won't be the apple of everyone's eye. And I see we've got the great Michael Howell in the room. He may want to weigh on this as well. But do you have any bigger thoughts about is this something of longer term significance, or that's just too hard to predict at this point? And for the short run, is all you're willing to go out on a limb?
Well, I mean, I think the organization of the BRICS countries is actually potentially quite important. Now, I talked to a lot of people who say, no, they'll never, they can't approach the U.S. Look at how weak they are. Maybe I can just interject here for a minute about what's going on in Argentina, because I think this actually may have a role in what the system looks like, I think that's really your question going forward. Does it include the dollar or not? And if it does include the dollar, what role is it? So, if you're not familiar with, they just had an election in Argentina, and they elected a guy who definitely needs a haircut, but he also announces himself or describes himself as an anarcho-capitalist. And one of his ideas is to replace or end the Argentinian central bank. Now, I'm going to just skip here and just for a minute to another country. I listened to the Singapore central bank chief the other day, and he said the future of the financial system globally is going to encompass three new areas. There'll be three things that will be used: CBDCs, central bank digital currencies. The second thing that will be launched will be tokenization of bank liabilities. The third thing will be a stable coin that actually works. He didn't say anything about central banks. He didn't say anything about dollars. Now, you don't really need, I don't think, a central bank in the kind of financial world that he's describing. So here we have a guy who's now the duly elected leader of Argentina. I believe he probably was funded by bankers. Somehow it got organized down there after. I mean, that used to be one of the 10 richest countries in the world. They've had 100 years of just disastrous economic policy, disastrous inflation. I think it was 140% this year. And what I think is happening is the powers that be have brought this guy in, and he's the science experiment. And Argentina is a science. If it doesn't work, if the adoption of a non-dollar or some kind of a new system that might include all those things that the central bank chief in Singapore discussed, and it doesn't work, how much worse can it be? Let's write it off and say, well, it's Argentina. But what happens if it works? And I don't think it's going to take a whole heck of a lot here to make things better in Argentina. I don't think there's one other possibility here, and I'm all wrong about where this goes, and instead they dollarize it. By the way, I saw this afternoon that the new Argentina president basically is starting to turn his back on China, and China's been funding them with currency swaps. They've had the rights to put a satellite tracking station down in southern Argentina. They can watch everybody's satellites that go across the southern hemisphere. They wanted to build a port in Tierra del Fuego. Basically, China was taking over Argentina, and all of a sudden, this guy gets in office, and he's going to reverse all of that. This is a big deal. And by the way, so I put a 1% allocation in the Argentinian index, which we'll see how this goes. But for the dollar, it's like the countdown is beginning.
Right. Just staying with that, running with the political angle, and again, I don't want this to devolve into a big political discussion. So you've had in Argentina this surprise election. You had in the Netherlands, Geert Wilders get elected.
Yep.
I think it was in New Zealand. There was a similar
Yes. Yep.
right-leaning drift. I'm missing one or two others, but is this a seed of something bigger? Do you believe? And I don't know, Penny, for your thoughts about the election situation here in 2024 in the United States.
Well, here in Europe, they have an emerging immigrant problem. I mean, it's obvious here. Germany, the second largest political group now, is the AfD, which is a conservative group. On the news here every night, whether I watch a French channel, a German channel, a Dutch, it doesn't matter what channel I look at. They're all highlighting this as an issue that's just gotten out of control. They can't afford it. The crime is going through the roof. I think what's coming here is deportations, and it's going to come from some countries like Germany, where I would never in a million years have thought they would actually start deporting people, but I think they are going to now, and it's going to become politically popular to do so. Now, here in Switzerland, where I am now, it's been very odd this week because there are police everywhere. They're in the train stations, they're on the trains, they're walking down the Bahnhofstrasse, they're making themselves very, very visible. And when I ask the locals here what's going on, this is what they name is the migration problem. I think this is going to come to the States as well. But for now, it's centered here in continental Europe and in the UK. I don't know what it does to the markets, if anything, but I can tell you that economically, this is going to create some turmoil.
Just a little more perspective. What's going on in Europe? Things are still pretty. Economies and what's your observation on this trip to Switzerland? That I know you're a regular traveler there, but what strikes you in terms of a change at the margin and what's going on in Europe?
Marginal recessions in some of the bigger markets, like Germany. Here, and they have, by the way, they've hit their 2% inflation target here. They're at 1.6 or 1.7, mostly because of the strong currency. But it just looks to me like things have slowed down. It's not bad. It's not they're not in a deep recession, but it has slowed down. That's pretty obvious. I mean, prices, for instance, of things I use, like airplanes and hotels and so forth, they're actually pretty reasonable. So I think they're at a little bit different point in their cycle here than we are in the U.S. And actually, it's interesting in the U.S. I mean, the government is just still spending money like. I mean, we'd be in recession if it wasn't for all the government spending in the last year. Here, they're actually running up against some debt problems, and the German government, I think they can't spend. I think they can't. They've hit their debt limit, I believe it is, through year end, and they're actually trapped. They can't spend any more money. So it's a different picture here. But it's really the thing that's different is the migrant problem, the immigration problem.
So, Larry, just staying on the spending issue for 1 second, given that we have an election year coming, and nobody gets elected by cutting spending. At least that doesn't work.
Yep.
I mean, doesn't it fall to the role of Mr. Market to apply discipline? And are we not looking at a case ultimately? Maybe this is too long term, but I kind of remind of Stein's law. That which can't go on won't. I mean,
Mm-hmm.
it's just extraordinary the deficits that we're running, and supposedly we're not in a recession. I mean, does this inform sort of your longer term dollar view? This just seems crazy what we're doing here. It's not sustainable. So I think you've written about the need to monetize this, and it's one of the reasons why you think we're going to be, again, forget about the next few months, but looking at longer term, you think we're in a higher interest rate, higher inflationary era, if I understand you correctly.
Yeah, I mean, we're kind of repeating what happened from 1963 to 80 with a little bit of a twist. But after we had, the first run up from 2 to 6% CPI, from 63 to 70. We had about a 30-month hiatus, which we're in now. We're in about the 20th month. So we could go another, middle of next year. That would be a normal repeat. But then we had the second boom in inflation, and it was the Middle Eastern war that kicked it off. Oil prices went through the roof. The currency markets reformed after Bretton Woods. I mean, we could see all of those things happen again very easily in this cycle.
Right. Awesome.
And that's my bet, is we're going to see some variation of that.
Got it. All right. I'm going to stop badgering you with questions and turn it over to some others in the room. I've got some more for you, but let's first go to Ramos, and then Ramos. After Ramos, we'll go to Daniel. Ramos, welcome. The floor is yours.
Hey, how's it going? I appreciate you taking my question. Really, really great talk, Larry. I was just wondering, going back to your comments on energy equities, and I believe you said you were bullish on them in terms of their sort of relative underperformance of energy equities versus the commodity itself. And you mentioned Exxon's acquisition of Pioneer. I was just wondering, in terms of like that acquisition was a stock, an all stock purchase. And do you think there's any
Mm-hmm.
information there? Are you concerned perhaps of like that maybe think that the stock's overvalued? I'm just wondering why you believe there's been this underperformance versus the commodity itself. And yeah, just your thoughts on that. Appreciate it.
Yeah, sure. Well, I think part of it is ESG regulation. Part of it was just the stigma that investment managers have. They're in some cases, I mean, they've said this to me, is they're afraid to put too much fossil fuel exposure in their portfolios. Now, I have also seen it start to sneak into portfolios, which is the interesting thing. My own view, Primos, is that this whole ESG thing was set up basically by the UN. It was a government set up timeline and targeting without any or very little, if any, respect for how markets would behave. And it being an arbitrary timeline, it's not going to work. And I think it's going to become very obvious. I mean, all over Europe here, that's another big topic here, is how do you get your power? Well, here in Switzerland, they get hydropower and they import from France. In Germany, they need gas, which is another reason I'm really bullish on this stuff in the States. Is natural gas in the U.S. is, I think it's what, $3 a million cubic feet or something now. Over here, they're paying 11, and these contracts that are being run to the U.S. LNG carriers, they're getting 20-year contracts here, and there is the people I talk to in Texas tell me they think that basically that $3 gas they're going to be sending out here is going to be priced anywhere from 10 to 15 by the time it gets to Europe, because the Russian gas will not come back. So, I look at all that and I think, okay, so why did Exxon do this? Well, I think they did it because they basically bought the one area really in the country where you still got growth in production, and that's the Permian, and that's where Pioneer was. That's what was the basis of the assets. And it's actually an interesting time to look at Exxon too, because it was a stock for stock deal. The ARBs have been selling Exxon and buying PDXD. So when the deal closes, the ARBs will have to cover the shorts, and off you go. So that's how I looked at it.
Thanks, Ramos. Daniel, long time. Good to see you. What's on your mind, Daniel? The floor is yours. Daniel, you there? No?
Oh, yeah, I'm here. Sorry.
There you go. What's up, man?
Yeah, how are you, George?
We're good. You got a question for Larry?
Yeah, good to see you, Larry. Yeah, Larry, I just wanted to know your thoughts on the bonds. I'll just keep it very broad and like to hear your thoughts on the bonds. On specifically 10 years. And I'm not a super expert on this, but I just want to know your thoughts.
Yeah.
Where? Yeah, go ahead.
Yeah. Well, the 10-year treasuries, we think the yields will drop about another 50 to 100 basis points, and it'll be now. That will be the close. It'll be the low in inflation expectations as well. And then they will both turn up. So the next high I have on the 10-year yield is 6.10. So it's going to be a very meaningful run if I'm right, and it goes from 3.5 to 6.10. But I think that's probably a 2025 event.
Yeah, I wow, you said exactly what I was thinking. The 3.5 to 3.7 area was one to look at for the low, and okay, great, thank you. That was all I wanted to hear.
Thanks, Daniel. Okay, we next now go to another friend, Surya Japon. The floor is yours. Good to see you. How you been?
Hi, thank you for taking my question. I'm very excited that my goal is finally and miners are finally starting to work, but I would like to ask about silver. If we'll get a recession, which I think we'll get at some point, what do you think about silver? Is it going higher with gold or lower because of industrial demand? And second question will be, what do you think about coal companies? Thank you.
Silver will go up with gold. In fact, usually at the end of the moves, it tends to outperform gold, but that's a ways away. I mean, we own silver. We own some silver equities. There aren't many to own, but we're long. I didn't quite catch the second question though, George. Did you?
It was about coal companies. Coal.
Coal? Did you
Yeah,
say coal?
yeah, Larry. So the question is the gold stocks as
Oh,
opposed
the companies.
to the companies. Yeah.
Oh,
No,
yeah. No.
sorry. Coal. Coal. COL.
Oh, coal.
Oh, it is
Sorry,
coal.
Sorry, coal.
Okay.
The basic.
Yeah,
Yeah.
that's the new black gold, I guess. Coal. Yep.
Can't help you on that one, sir. Sorry. I don't watch them.
Okay, thank you.
Sure.
Larry, one of your interesting trademarks you always talk about. It's always interesting questions you're not asked.
Mm-hmm.
So, what's not? What are people not focusing on or not interested? Like, for instance, I've read in some quarters that despite the fact that Japan's gone to multi-decade highs, no one really cares about Japan. I don't know, I'm just throwing stuff out. Or China being given up for dead or whatever. I mean, what are you not being asked? Where you think there possibly might be an opportunity? I'm not asking you to be contrarian. I'm not be a dumb contrarian, but what strikes you as just suffering totally from complete indifference and being avoided?
Geographically, we get no questions about anything in South America, where there are a few things to do. It's not the easiest place to invest, but if I look around the world, that's one. The second place I get no questions is about investing in the Middle East. Yet I know we've had some friends go out to the Middle East, talk to the Saudis, talk to MBS, interviewed MBS, and they are extremely impressed with this guy. They want to invest there, he's if you watch what he's doing, he's buying sports companies and art and soccer teams and all the rest of it. And basically, his pitch is if he can do this and bring tourists in, that's the next thing. I guess in Saudi Arabia is they're going to start bringing tourists in, hopefully, to see these things. If you can raise your GDP by from 3 to 4%, why not do it? And I think that's a big. There's not much Western capital out there, but they don't need it. They have plenty. So Middle Eastern, China, the number of questions have really gone away. They're not completely gone, but the consensus there is it's uninvestable. I mean, I heard it all over Asia. I hear it all over Europe. Anywhere I go, it's now uninvestable,
Right.
which is making me think, George, we're close here to having something actually go right for those guys. And if you want to talk tech, I mean, I can show you Chinese tech companies that are trading at 10 times earnings with 30-40% growth rates. Never got a question about them. They're the
Staying with
standout group.
yeah, just staying on tech. Do you find? Let's go the other way. Do you? Because I think it was something you wrote recently, if not even someone else I read where I think it was talking to European institutions. They're sort of viewing the Magnificent Seven or U.S. tech as sort of unique assets. It's almost like an alternative to a government bond fund or whatever.
Yeah.
And there's no other place you can put. I think you wrote that. Does your sort of I mean, I know you think that this leadership will continue to go up, but um, to strike you as just sort of top of mind in most places that you go in terms of interest?
They will bring it up. Usually, I bring it up before they do
Mm.
because most of the time they're going to get there anyway. They own it here. They own a lot of this stuff. In fact, if I had to guess, Switzerland's always a good measure for this. If I was looking at the buy list for a lot of these banks, my guess is it's the big seven stocks and not much else in the States.
Does that call? By the way, I haven't looked at the BIS. Was it BIS or no SMB? Is the SMB still hodling these stocks? I mean, they've done incredibly well. I would imagine if they have.
Oh yeah, I mean, we talked to somebody the other day, and I said, "You still have all that Apple?" Oh yeah, we're quite happy. Best holding.
uh, all right. Oh no! Someone call security! Security! We got another card-carrying member of the Minnesota Mafia in the room, right next to you, Larry. Our good friend Dave Nikoski. Dave, good to see you. I
Thanks
guess
for having me up,
you,
George.
you
Appreciate it.
you guys are Gophers, right? Is that it was go? Like, yeah,
Minnesota Gophers, right there.
Minnesota Gophers. All right, okay. So I'll let you two have at it. David, the floor is yours.
Yeah, I want to bounce something off of Larry. Back in 2002, the U.S. dollar remained strong even throughout the bubble up until about April of 2002. When the dollar broke that uptrend, you saw a repatriation. The U.S. markets have been the hottest in the world for 20 years since then.
Mm-hmm.
Do you see? There is it's an anomaly. I've made one call in my career in 38 years. That there'd be a repatriation upon that break. And if you look at the U.S. dollar index and look at the S&P during that April of 2002, this market seems eerily similar to me where, if the dollar does break the longer term uptrend, which is considerable distance from here, do you have any thoughts on that?
Yeah, I have three thoughts. What could well happen here, and something has to happen. I think, David, to help fund the deficits we're looking at. Here in Switzerland and across Europe, they've done something for years, and that is they changed legislation and they forced pension funds and insurance companies to buy a certain percentage of their assets in government bonds. We haven't done that yet, but I think eventually we'll get there. The second thing is I think we're going to have tax hikes, and that will come not next year because it's obviously an election year. And you don't win by our fellow gopher Walter Mondale proved that in 1984, didn't he? He said he was going to raise taxes, and I think Reagan beat him 49-1 or something. I think that's probably a topic for 25 as well. But the third thing is actually repatriation. That's what you're suggesting. I mean, they've done this before where they've made it more attractive for U.S. companies and investors to repatriate monies back, and this I think would all be directed at an effort to help fund the deficit. The other possibility, I think, in terms of the repatriation, is I noticed this morning that I think U.S. equities they may be at an all-time high in terms of the market weight, MSCI World. And if you go back and look, I mean, Japan did this. I think it was 1990. That was the last big call. No, it wasn't the last big call in Japan. That was 2012. But in 1990, I think Japan was 50, but George would know this. What were they, like 55, 60%, George, of the MSCI World?
I could tell you that Japan got up to 66% of EFA.
There you go.
Which is for those that don't follow that index, it's the non-U.S. S&P, if you will. It was 66% of EFA. And I haven't looked lately, but what is it, like 10 or 15 or something now? Some crazy low number. I don't know what it is, but yeah. Things you don't see at the bottom, as they say.
So it's been 22 years, basically. Money left. It left the Japanese market, and that's the other thing I really wonder about, David, is there's a price for everything, as you know. And right now the price, although I said tech is still the leader, it's expensive. It's going to get more expensive. This really reminds me a lot of late 99 and early 2000.
Absolutely. I'm on that same page. And, everything that occurred when the dollar did break that uptrend, that was the commodity reign, from 2003 to 2009. Mm-hmm. So I see a lot of very, very similar patterns. When I'm looking through, even we became bullish on the coal stocks. It was June of 20. You were breaking the long-term downtrend. The KOL index stopped trading, and coal just went straight up. AMR is up, I think, 18 times greater than Nvidia since June of 20. Wow. So there's things that people don't talk about that, when you're looking at relative strength. I'm very bullish Brazil. Don't like the leader, but that doesn't tell it. I can certainly see funds are flowing in there. And I like Latin. All of South America actually looks much better than other emerging countries. Mexico, we've seen a huge, a significant amount of reshoring. Um, Mexico looks great. You see, they just, surpassed China in terms of imports into the United States from Mexico. But, it seems to me, China's the second largest investor in Mexico behind the US. So you're not getting a real GDP number from China because they have, invested in so many other countries that we're importing from. So it's not a real accurate assessment, I don't think, from a GDP standpoint, what you see in China.
That's absolutely correct.
So, Dave, as you look at the charts, are we possibly setting up for a scenario where, and again, I'm not talking about next week or next month, but looking at over the next couple of few years, that and the world's a very heterogeneous place. I get it. I mean, Europe's not the same as South America, but do you think there'd be areas, regions, be it Latin America, Japan, whatever, where you might do a lot better than just buying the S&P?
My view has been the U.S. migrates and builds up a country for a long period of time. During the 80s, 1970, no one knew what a Honda or a Toyota was in the U.S. By end of 1980, everyone knew what a Honda and Toyota was. We built Japan to what they were, and they collapsed in '89 under the same scenario that China is having difficulties, which is real estate. Now we're pulling the levers and moving out of China, and the next move, again, much like that 10-year period from 1970 to 1980, we're looking for. I want to say the U.S. and I term it, and don't take this in a bad way for anyone that's pro-American, as I am, because I am American. But we use financial imperialism. We find a cheaper way to produce goods that we can't cheap here. We relocate dirty energies into other countries. You're seeing that with even Germany today. Michelin is closing down 3 plants. They can't build tires. They just took one of their large steel plants and put it in Brazil. So we're finding our next opportunity for the next 20 years to build up, and I would say it's, in my opinion, I think it's going to be South America and Mexico.
Yeah.
Yep. And watch Brazil.
I like Brazil. I've been all over it. Yeah. Love it.
I was having a talk the other day with a guy. It's George, you probably know him. I won't say his name. He's a very famous EM investor out of Boston. And he was the one who said to me, he said, you got to watch what's going on now in Argentina, Brazil, and the U.S. because if they get together and align, he just went, wow. I mean, just think about the resource power of those 3 countries if they align.
Yeah, it's also I'm sure we've all seen that table. If not, I can retweet it out. I think it comes from GavCal. They show by decade the 10 largest market caps in the world, and both of you gophers would know this. You go back to early 80s, it's energy stocks, and late 80s, it's Japan, and then you get the tech stocks, and then you get the financial stocks, commodity stocks, the China stocks, wash, rinse, repeat. So here we are. It's U.S. tech. So it's not obvious when it's happening, and I'm not saying that we should sell these stocks, but I kind of wonder 10 years from now what it's going to look like. I think it's the one thing that's constant is change. So I don't know. Be curious to see how this, because the values are certainly there. It's a question of whether the macroeconomics back it up. But David, I'm encouraged to hear that you think the charts are looking that way. So, all right. Any other? By the way, if anyone's interested, Larry, if you're interested in learning more from Larry, you can obviously DM him, or his email address is larry.jeddeloh. That's JEDDELOH. Larry.jeddeloh at tisgroup.net, or if you need further help, just contact me. Like I said, I've known Larry for decades, and I think he's really got a differentiated point of view And so find it extremely helpful in my decision making process. Carpathia, good to see you, my friend. Welcome. The floor is yours. How are you?
Welcome. Thanks, George, for having this. A couple of real quick technical questions. I missed some things. I had some technical issues. Earlier, you were talking about 2075 on gold, 3,500, 4,000. And then you said another number, which I missed, would be 12,000. What was that number, Larry?
2,100.
Okay, it's
Close above 2,100 a month.
I guessed that, but I wanted to make sure. The second part I want to clarify because I too think that, and I've said this on previous spaces, all roads lead to yield curve control, but they're not going to call it that. And they'll call it something else, some bullshit name. But you mentioned my antenna went up when you said the forced pensions. I also believe that. Do you think they'll go as deep as means testing, an IRA, if it's over X amount of capital? If you want to retain your tax deferred status or Roth status, you have to have, name a percentage in treasuries. Thanks, and I'll listen.
Yes, I think they'll take it deeper than, it's already happened here in Switzerland. It's interesting to talk to people about, I'll give you an example. This isn't a pension example, but I was having coffee yesterday with a former client. He's retired now, so he's a retired investment manager. And we were talking stocks, and I said, well, I mentioned the Exxon thing. And he said, that's too short term, because the way the tax authorities look at it here is if they decide that I'm investing for a living, I don't get the capital gains tax break. And I said, well, how do they determine whether or not you're investing for a living? And he said, they're very vague about it. It's a gray area, but they know what I did for a living. And if I trade too much, they will come back and declare me to be can you believe this? Investing for a living. And otherwise here, capital gains are zero. So you go from 0 to maybe 40% if they arbitrarily decide that you're actually trying to make a living trading your own money. I mean, and it's it's really at the discretion of the tax authority, who, by the way, here I think are actually quite good. They're quite fair. But I think it's illustrative of what's coming. And it's not just in the U.S. I mean, all these indebted first world countries, they're hunting for. Well, look what the U.S. did. We're going to hire 87,000 IRS agents. I mean, to do what? Basically, I think it's to go at people that have never been audited before. It's not the upper class; it's the middle class. That's where the tax revenue is, and it's in the pensions. It's in everybody's 401ks and their Roths and their IRAs, and I think that's coming. But it's not going to come next year. It's going to be 25 or later.
Large IRAs, they're screwed. Large Roths, basically, I'm screwed. They've got every fingerprint. I've been in every federal FINRA database and FAA forever. So, thanks.
Thanks anyway. Sorry.
Thanks, Carpathia. Let's now go to Billy Big Bucks. How are you, my friend? Good to see you. What's going on, Billy?
Hey, George. Nice to be here. I'm taking that space. I don't know, maybe 40 minutes late, but I had a question, and maybe you covered that ground before, but 2020, 2021 was like, or 2021 was like the mother of all speculations, right? I mean, you had the Cathy Woods stock, you had crypto, you had the metaverse, you had SPACs. You had IPOs, like snowflakes at 100 times revenues, and so on and so forth. And so, for sure, it seems like, the top in 2021, should have been the top in, in high tech, and 2022 was a tech wreck where, all these crazy stocks, collapsed by, 70%, 80%, and some of the large cap stocks, the Magnificent Seven, or the FANGs, or whatever the acronyms. Stocks like Google, Amazon, and so on went down by 40 and 50%. And you would have thought that after something like that, the sector would have at the very least been dead for quite some time. And here we are in 2023, and we back into these like the Magnificent Seven, new name but same stocks, with some of them breaking to new highs like Microsoft and Apple. And I don't recall any sort of huge speculative bubble like 2020 2021 being one down like in 2022, and then a few months later the same stocks are making new highs at ever higher valuations. How do you explain that?
Is that for George or for me?
For anyone
Well,
who's can
Anyone.
enlighten me. Plus the fact that interest rates have moved from 0 to 5%.
Mm-hmm. I can give you maybe a stab at it, because it's what I think has been adopted. I think it's been adopted by some of the institutional guys that I talk to. A number of them have described to me now. I've asked them that question: is why did you do it now? Why are you buying these now? And they said because they're defensive growth. I mean, some of these guys are actually looking at these. They're not assured growth. They don't say that, but they are liquid. They know they can get out. They grew even through a slowdown. They'll grow through this slowdown. It's better than a bond. Those are the answers they're giving me. And I don't know what the right multiple is for that. I'm not sure they know. But what I do know is they don't want to own bonds if they don't have to. So
Well,
then the liquidity piece to that is really important, because they're actually more liquid now than some parts of the Treasury yield curve.
okay, but
and
when you're saying you don't know what multiple it should be, but one thing is certain, I would think, is that the multiples got to be considerably lower at 5% interest rates than 0% interest rates. So and the multiples are higher.
Well, then we need to think about why that is.
yeah, I think Larry, what you were talking before about defensive. I mean, I know if you look at getting away just from the idiosyncratic nature of these stocks, so they are unique. If you just look at by factor what's working in the market's been favoring companies, with generalized basis, strong balance sheets, high interest coverage ratio, strong cash flows, et cetera, et cetera. And so if you just ignored those 7 stocks and just looked at companies with similar characteristics, I think you'd see, okay, maybe not to the same degree, but those companies with those characteristics have been outperforming. And I think the other problem too you have here, and Billy, you would know this, and Dave, and anyone who's been in the markets for a long time, Larry, when you get into big money needs big stocks, and that was true even before you had such widespread indexation. And so I guess if you're defining risk as the extent to which you underperform the index, like Larry, you were saying earlier at the start of the conversation, earlier on about what goes on in Australia. I mean, not that I would go buy Apple, and that's okay, but if you're a fund, tell me how you don't buy Apple when it's what 7% of the S&P. So it's like one giant. I don't know. It keeps going until it doesn't. But Billy, I'm totally with you. I mean, the fact that in the face of rising rates, these stocks they don't seem to care. It really is something to behold. Michael Howell, do you want to weigh in?
Yeah, hi George.
Good to see you.
Good to hear you again. Good to be back on Spaces. Larry, awesome interview. Great insights. I wanted to ask you one question. The credit markets, they matter a lot to the Fed. What do you think? How do you see them?
I missed the last part of the question, Michael. Could you repeat it?
Yeah.
The question was your views on credit markets. Michael was asking, what do you think of credit markets?
Yeah. So I'm assuming you're talking about corporate credits, Michael?
Correct. Yeah.
Well, we talked to a few, not a lot, but a few distressed managers, and basically what they're telling me is they can get 15 to 16% now on 3-year loans to triple C type companies. And I think that's where the real rate of interest is, and it's still available. They have capital, so this is private credit, not and I think that's another area to explore at some point. Is there's a lot of money being committed now to private credit lending, new money out of sovereign funds that we talk to, and there's it's different. It's different now. It's a much larger number, and I think one of the reasons they're doing it actually goes back to the prior question, and that is about equities. I mean, we've got you probably have some of the same clients we do, Michael. Some of these guys now are doing 10-year earnings models for the equities that they own, because once they buy them, they can't sell them, and they know that. So they're looking for other outlets for long-term money, and the private lending sector is they're giving some liquidity to it by putting more capital in it. And actually, I find many of these guys who do the credit work are very good stock analysts because they're looking at the balance sheet and they're just investing higher up in the capital structure. So I don't think it's unhealthy at this point. What I do think is really worrisome from a credit perspective for me is in the Midwest, we have a lot of small banks, community banks, and I've had bankers tell us that they literally have no money to lend now because the depositors have figured out over the last couple of years that they're getting 1 bip on their checking account and 10 bips on their savings account, and maybe they get 100 bips on a CD, but if they move it over to move their balances over to the money fund, they get 500. And so it's those deposits that underline or underwrite the $10 worth of loans for every dollar deposit they have. So they're losing their deposit base. And that's the risk, I think, here is that money just continues to disintermediate in the banking system. In fact, I ran a graph the other day about bank lending, and it's now gone negative. And I think this is the reason, is the especially for small and community banks, and it's going to work its way up to the regional banks probably sooner rather than later. If you're a borrower, you're going to have trouble getting, especially if you're a small community bank. I mean, these guys have one way to make money, and that's make loans. They don't have other products. And this is the guts of the small economy, the small business economy, where we grow jobs and start new businesses in the States. That's the part of the credit markets I would really, if I'm going to be wrong about no recession next year, that's what will do it.
Right. By the way, Larry, Michael's been very, I think he shares your views, particularly, Michael, I don't know if you wanted to weigh in on your gold view. I know it's been sort of top of mind for you recently, and the whole liquidity thing. You've been big on expanding the balance sheet and liquidity increasing from the perspective of the central banks. And I think you believe gold's going to feature prominently as a result. I'm not sure who's more bullish on gold, Michael, Larry, or yourself. So
it's a fight. We put out a research note this morning which set a target for gold at $6,000 an ounce. So that may be put into perspective. And the reason is that there's going to be an awful lot of money printing to pay for this debt. And I'm upbeat on markets, and I think George knows. I mean, our view is that global liquidity drives everything. We track that. I've done that for decades. The cycle bottomed in October of 22. It's rising, maybe not in a straight line, but it's rising until 2025. And so, I think everything you have said, Larry, is music to my ears, because it's exactly how we see things from a different perspective.
Yeah.
Wow.
That's always good.
That's great. Michael, stay up there. You might have another question here for some others. This is great. We've got, let's see, Ivy Madison, please. The floor is yours, Ivy. You have a question?
Yes. Hi, George and Larry. Thank you for taking me. This is a great informative space. Larry, you've given us some good targets for gold and treasuries. Do you have a price target for the S&P 500 for 2024 peak?
Yes.
Do you care to share it? You said we're going to go on a pretty good run here, so I'm curious how high you're thinking.
I think I'm going to tease you, Ivy, but it's I think getting direction is a big enough. I mean, you can put him in the positive column. That's important, and he's very bullish. And I don't know. I think I don't want to put words in Larry's mouth, but I think it'd be sheer speculation. Not that we do anything otherwise for a living, but Larry, maybe if not in terms of level, but in terms of time, you said you thought the market would be buoyant for the first few months of the year. Did I recall correctly?
Yeah, it may last into the mid cycle part of the year, but basically the first quarter should be good. And if we get a correction that passes muster in about April, it'll go up basically for the rest of the year. Now, if that turns out to be the case, my S&P target's about the same as Michael's gold target.
There you go. Thanks for the question, Ivy. Futurist, the floor is yours. Do you have a question?
Yeah, actually, I got into the space right at the end when you were talking about the banks and individual depositors. I'm really curious, and I don't know if you've already touched on this, but it really, at least I'm from Florida. I recently had a Chase account closed with a lot of money for absolutely no reason. We have a lot of people in Wells Fargo now facing the same thing. And from what I hear or understand from what you were saying, is that all these banks, all the major banks, obviously, are all of a sudden closing all these accounts. And I guess the ramifications of that is it's gonna push for a recession faster, because obviously a lot of these individual deposits are what supports loans, which they're not even giving, right? So you're first giving loans at very high. First, they're higher interest rates than normal. You got to put 50% deposit, literally, at least in Florida, if you want a house. And if you can't get the insurance on the house, which is impossible, it's really going to be cash. So it's like this completely different market that it's man-made. I don't see this as a cycle. So I'm just curious to know what you guys think about what's going on.
Man-made is a good term, I think. There's got to be a reason why certain banks are going after. Sounds like you're a top-tier customer. I was speaking more to the small bank and community banking part of the market, but I have heard from other places in the country exactly what you're describing, where people's accounts are being closed for apparently no reason, but there is a reason. What was it JP Morgan said? There's a reason for everything, a good reason and the real reason. So I don't know what the good reason is they're giving you, but the real reason, it seems to me, is they're trying to reduce their exposure to something. And maybe the something is the housing market. I know I looked at a number this morning that the new build construction home average price now is down about 20% year over year. It's different if it's an existing home, but maybe that's what they're trying to get. One of the things anyway, one of the asset that they're invested in, they're trying to reduce their exposure to. But it doesn't make. I owned part of a bank once years ago, and I used to sit in the credit committee things, which were excruciating. I've never had a desire to go back and do that again. It may be regulatory. Now that you're making me think about this, because I sat through some of those regulatory meetings too, when the FDIC would come in, or we had a state charter, or the OCC, and it was reminiscent of what you're describing, where they would find banks that they thought they had problems with, and it was just almost indiscriminate what they would force those banks to do in terms of reining in their lending book and what they could lend on. I mean, basically, they would shut them down without shutting them down publicly.
Right. Thanks for the question. All right. So again, if anyone's interested in Larry's getting his stuff, DM him, or you can reach out to him at larry.jeddeloh, Jeddeloh, larry.jeddeloh at tisgroup.com.
.net.
.net. Sorry, my bad. All right, this has been terrific. I think we're going to call it a night. Larry, this is great that you came by. Look forward to having you again in the future. And for everyone else in the room, we'll be doing another space next week with Dave Lundgren, formerly of Wellington. So hopefully we'll get back in the saddle and make these spaces a regular feature again. So Larry, I want to thank you so much. Everyone's learned a lot, and hope you've enjoyed it and you've learned something as well. And good night to all. Talk to you next week. Bye-bye.
Thanks, George.
Take care. Bye.